Good afternoon. So I'm here today with Matt Hansford, who is Head of Europe for Portfolio Financing at Barings. Welcome, Matt. I wonder if you might first just give us a brief introduction to Barings and perhaps also the portfolio financing part of that business as well.
Yeah, brilliant. Thanks for having me. So Barings is a 450 billion asset manager. Uniquely, it's owned by MassMutual, so it's got the benefit of a large permanent capital insurance capital base, and then it's got over 2,000 third-party clients globally. Very much credit-focused shop, both public and private credit. And our portfolio finance team, over 30 people dedicated to portfolio finance. It was a team like Barings in some way, born in MassMutual. So we built the business in MassMutual, and we moved it across to Barings at the start of last year, really to open up the strategy to third-party investors. And across that time, we've invested over 56 billion into this space across a range of different asset classes and structures within portfolio financing.
Great. Okay. So, and I guess portfolio financing, others may refer to it as NAV financing, I suppose. You mentioned opening that up to third-party investors. What do investors need to know about this asset class? And I guess why is it now that there's quite a lot of growth within the asset class as well?
Yeah, it's certainly an area that's had a lot of headlines. When I talk to investors, I think there's really three areas that they need to consider. There's certainly three intersection points that they will be involved in. Number one, there's investors monitoring and assessing portfolio financing that GPs may undertake in their own portfolio. So that's the first area that they will come across, NAV or portfolio financing. Then there's their own use of portfolio financing. More and more investors are looking at portfolio financing as a tool to manage their liquidity and manage their portfolio. And the third is investing in portfolio financing. And actually, within portfolio financing, there's a range of different places you can invest. It's a really wide space. Okay. Everything from private IG at one end to really an alternative or a diversifier to direct lending on the other end of the spectrum. A lot of the growth, you mentioned growth and why is this a growing or interesting space? There are a huge number of tailwinds driving this. There's a lot of use cases from LPs and GPs. And they're really natural themes that everybody will recognise in private markets. The first is tailoring of investments. Put really simply, imagine you're a large LP, you're really interested in a strategy, let's say it's direct lending strategy, and you say, look, I'd love to put a 200 million SMA in place to invest in this direct lending fund. I love the GP, I love the strategy, but I want to tailor that, and that's quite normal. Actually, I want to tailor the returns. Maybe the strategy generates a 12% gross return. Actually, for my allocation, maybe I need 14%. Okay. So to do that, I'll mix my capital as an LP with portfolio financing. Then there's the growth of the secondary market. We've seen the secondary market grow from 90 billion of annual flow pre-COVID times to, I think some people say it's going to be 230 billion potentially of deal flow this year. And portfolio financing works in that secondary market, often as acquisition financing, otherwise a tool for secondary funds to help manage their portfolio. And then you've got asset managers, and we've seen asset managers diversify, we've seen them grow with longer hold periods, things like CVs. There's a whole bunch of different needs for capital in a GP or an asset manager, and capital is more and more held in their funds within those longer hold periods. So portfolio financing is a way to create liquidity within an asset manager, really to help them grow or help them with other strategic needs like acquisitions or succession.
Yeah, I think that's one of the key themes of the conference this week has actually been that kind of consolidation play, hasn't it? You talked there about a lot of the use cases. I mean, do you have a sense of what the size of the opportunity is here and how that might continue to grow over the coming years?
We did a piece of work and we estimated that the market was over 200 billion per annum of investment opportunity a huge amount. And that's obviously of a really wide section. That is the opportunity, within the credit market and tailoring credit investments for LPs, levered funds, SMAs, the growth of private credit. So you've got that part of the market. You've got secondaries and fund of funds. And again, that's an area that's growing massively. So naturally, a place that portfolio finance works very well. And as we said, the diversifying and growing of asset managers. And the thing that sits above all of that is all of these factors are growing. Private markets is growing fast. And private markets is growing at twice the rate of bank balance sheets.
Okay.
Now, bank balance sheets historically are the capital source that was used for portfolio finance. But banks cannot keep up with the growth of private markets. And so what we've seen is there's a natural gap that's then compounded by all these industry tailwinds to widen the gap. So the market needs institutional capital and needs ways to, or access points for that institutional capital to go into funds, go into portfolios, go into managers.
Just going back to the investors again, are there certain types of investors that are, I guess, either coming into your funds or the ones that are actually using this as a tool?
Yeah, we see a couple of profiles typically, and it's not exclusive, but the way we often see the conversations going, at one end of the spectrum, you've got investors which really will focus on capital efficiency, investors like insurers.
Yeah.
Capital efficiency is incredibly important. An insurer must hold a huge amount of its balance sheet assets in fixed income, investment grade credit. And they've got to find ways of increasing the spread on that fixed income investment grade book. So portfolio financing with a really naturally defensive profile through the diversity, through the equity in the structure, through the cross-collateralization and the controls, provides an investment grade private fixed income investment that will plug straight into an insurer's allocation. So at that end of the spectrum, that really core IG end of the spectrum, an insurer will find this very capital efficient and a way to really build in that allocation at scale. These are big transactions. So the scale to build in a diversified way quite quickly. At the other end, you've got the more of a triple B type of risk, so still investment grade risk or sub IG type of risk. Maybe a return more similar to direct lending, and that's where some investors will look at it. They'll say, look, we love direct lending, we're trying to find some of the diversifiers, the new ways to look at it. I've heard investors say, well, look, we can go up the risk into something like a capital solutions, or actually we can go across into something that's possibly more of a double B type of risk profile. So still a strong risk profile, but gets a similar return to direct lending. So you've got these two different approaches. One is very much capital efficiency, incredibly defensive IG. The other is less focused on capital efficiency, but really likes the return balanced off with the sort of diversified and defensive nature of the asset class.
On the other side of things, are there certain types of investors that are going back to the use cases that you talked about earlier, where the LPs are using your portfolio financing rather than the GP? Are there certain types of LP or certain types of situation where that's more prevalent?
Yeah, it really shows how the ecosystem all combines together at lots of different points. You really go back to the rise of the secondary market. Secondary market has been a brilliant tool to enable investors to create liquidity from their portfolios and really very actively manage the portfolio. And there's a number of ways you can do secondaries. But that's really one tool. That's a sale of positions. And there are lots of situations where that investor may want liquidity or may need liquidity, but it doesn't want to change the allocation of its portfolio. It's built this portfolio in a certain way, and it doesn't want to change the mix by selling certain positions. It wants to maintain the GP relationships, and actually there's some sensitivity around selling positions and how that'll affect relationships. Or they don't need that amount of liquidity. They don't need the full sale. And so their view is the discount in that situation is too great, or maybe the upside in the portfolio is too high. And so portfolio finance can come in as that debt-like solution, that credit solution that can come in and provide liquidity to the LPs without them selling positions, without them potentially giving up the upside. So it certainly won't substitute the secondary market, but just provides another tool in the toolkit when investors are thinking about that. And then you go back to the tailoring of returns. You go kind of full circle to what I talked about, that driver. GPs want to tailor returns. Investors quite often are coming to talk to us and saying, hey, look, this portfolio, we like this portfolio, we like this investment, but again, we want to tweak the returns. We want to put some level of financing in to create a different profile. So, it's not necessarily, again, it's portfolio management, but it's more returns and cash flow and liquidity management.
Final question for you. You mentioned earlier there have been a few headlines about this industry specifically. How do you see the future of the asset class? How do you accelerate the growth and adoption among both GPs and LPs?
Yeah, it's really important. I think some of the headlines have gone very much on, opinion, good or bad. I think with those three intersection points, how do you monitor and how do you understand, use cases by GPs in your portfolio? How do you use and how do you invest in portfolio finance? Talking more about all of those is naturally going to educate the market. Sure. It's going to educate investors and get them much more comfortable. There was some ILPA guidance released last year and feedback from the investor community as that's given them, a nice playbook and a way to think about this. A lot more comfort. But I think as you educate the market, you educate GPs, you educate LPs, and that creates that comfort, creates that transparency of solutions. And I think that'll once that continues to come through, that then helps accelerate this both as an investment option and, as we said, as a tool for others in the market to manage their portfolio.
Well, thank you very much. Really appreciate your time. Really interesting. Thanks so much.